8 trillion yuan. That is the number. In a span of just 2 weeks, the People's Bank of China injected 8 trillion yuan into their financial system. If you listen to the official news coming out of Beijing, this is nothing. They call it routine maintenance. They tell you this is just standard operating procedure for the Lunar New Year. The narrative is simple. People need cash for the holidays. So the central bank is just making sure the ATMs are full. But look at the scale. Routine maintenance does not look like this. You do not inject record-breaking amounts of cash into a banking system just because people are buying gifts. You do not flood the market with liquidity at a pace that eclipses previous years. If the engine is running smoothly, the government says the economy is stable. The math says the system is seizing up. What you are watching is not a holiday bonus. It is a rescue mission. China has quietly triggered a form of silent quantitative easing. They didn't announce it with a press conference. They didn't declare a new policy. But the money is moving. And the reason they are doing this in the dark is simple. If they admit why they need the cash, the illusion breaks. This is the liquidity illusion. On the surface, everything looks calm. The exchange rate is managed. The stock market is propped up. But underneath, the gears are grinding together. The central bank is pouring oil on the machine, not to make it go faster, but to stop it from exploding. To understand the danger, we have to look at the timeline. On February 4th, the central bank pushed 800 billion yuan into the system. It was a massive injection, but it wasn't enough. Just 9 days later, on February 13th, they shoved in another 1 trillion yuan, 2 massive spikes in under 10 days. Now, you need to understand the mechanism. This is where most people get confused. They hear injection, and they think of the American style of printing money. When the Federal Reserve in the US does quantitative easing, they usually buy assets. They take a bond off the bank's balance sheet and replace it with cash. It is a permanent swap. The bank gets the money, the Fed keeps the bond. It is like selling your car for cash. You have the money and you don't have to worry about the car anymore. China is doing something different. They are using a tool called reverse repos. This sounds technical, but it is actually very simple. Think of it like a pawn shop. In the Chinese model right now, the central bank is acting like the pawnbroker. The commercial banks are the desperate customers. These banks are sitting on assets that are losing value, or they simply cannot convert them to cash fast enough. But they have bills to pay today. They have withdrawals to cover today. So they go to the central bank, they hand over their collateral, their loans, their bonds, and the central bank gives them a short-term cash loan. The catch is, the banks have to buy their stuff back later. This is critical. The Federal Reserve gives money away. The People's Bank of China lends it against collateral. Why does this distinction matter? Because it proves the banks are facing a liquidity crunch, not a solvency crisis. Yet a solvency crisis means you are bankrupt. A liquidity crisis means you have money, but it is stuck in the walls and you can't get it out to pay the electric bill. The Chinese banking system is currently stuck in the walls. Estimates show there is a liquidity gap of nearly 2 trillion yuan right now. That is the hole in the bucket. That is how much cash is missing from the daily operations of the economy. The officials blame the tax season. They blame government bond issuance. They blame the holiday rush. These are convenient excuses. They cover up the structural rot. The reality is that money is not circulating. In a healthy economy, I pay you. You pay the grocer. The grocer pays the farmer. The money moves. Velocity is high. In China right now, the velocity is dying. The property sector has sucked the oxygen out of the room. Developers aren't paying back loans. Home buyers aren't taking out new mortgages. The cash goes into the property market, and it disappears. It gets trapped in unfinished buildings and bad debt. So the banks run dry. This 8 trillion yuan injection is the central bank desperately trying to refill the reservoir before the dam cracks. They are using the pawn shop mechanism to keep the banks alive for another week, another month. But here's the problem with using a pawn shop to pay your rent. Eventually you run out of things to pawn, and eventually the loan comes due. They are treating a gunshot wound with a Band-Aid. They are flooding the system with short-term cash to hide a long-term insolvency. This leads us directly into the trap they have built for themselves. The liquidity is hitting the banks, but it isn't reaching the people. It isn't reaching the businesses. It is getting stuck at the top. This is what economists call pushing on a string. You can pull a string to move something, but you can't push it. You can print all the money you want, but if the banks are too scared to lend it and the people are too scared to spend it, the money does nothing. It just sits there. And that is exactly what is happening. The injection is massive, but the inflation numbers are still flat. Consumer prices are weak. Producer prices are falling. That is the signal. If you print 8 trillion yuan and prices still go down, your money is broken. The transmission mechanism has failed. This is the setup for a Japan-style stagnation, but at a speed and scale that is terrifying. They are fighting deflation with debt. They are fighting a fire with gasoline, hoping the blast will suck the oxygen out and kill the flame. But the fire is still burning. To see why this strategy is failing, You have to look past the last 2 weeks. You have to look at the trend. The official story crumbles when you look at January. Before the Lunar New Year rush even started, the central bank was already pumping the system full of adrenaline. In January alone, they injected 900 billion yuan through a tool called the Medium Term Lending Facility, or MLF. After you account for the old loans that were expiring, that is a net addition of 700 billion yuan. Now, pause. If the 1.8 trillion in February was just for holiday cash, what was the 700 billion in January for? There was no holiday in January. And it goes back even further. This was the 11th consecutive month of net injections. For almost a full year, the central bank has been quietly feeding cash into the banking sector, month after month after month. A holiday doesn't last for a year. A routine operation doesn't require 11 straight months of emergency funding. This is a life support system. The difference between the February injections and the January injections is just the timeline. The February moves were short-term reverse repos, basically a payday loan for a few days or weeks. The MLF is different. It stands for Medium-Term Lending Facility. Think of the MLF as a second mortgage. The banks are taking this money for up to a year. They are locking in liquidity because they know they won't have the cash next week or next month. They are borrowing from the future to survive the present. So why is the central bank doing it this way? Why use these complicated backdoor channels, reverse repos and MLFS, instead of just doing what every other country does, cut interest rates? If the economy is slowing down, you lower the cost of borrowing. That is economics 101. You cut the rates, businesses borrow cheap money, they hire people, the economy grows. But China refuses to do it. They are keeping their benchmark rates mostly flat. Here is the trap. They cannot cut rates because of the United States. Right now, U.S. interest rates are high. If China lowers their rates significantly, the gap between the dollar and the yuan gets too big. Investors are simple creatures. They go where the yield is. If China cuts rates, money flees Beijing and flows to New York. This causes capital flight. The yuan collapses. The cost of imports skyrockets. It creates a currency crisis. So the People's Bank of China is handcuffed. They cannot touch the price of money. So they are trying to manipulate the volume of money. They are trying to cheat the laws of economics. They are keeping interest rates artificially high to please the currency markets while simultaneously flooding the banks with cash to stop a domestic collapse. It is a contradiction. They are stepping on the brake and the gas at the same time, and the engine is smoking. This brings us to the most dangerous signal in the data, the deflation trap. Despite trillions of yuan entering the system over the last year through the MLF, through reverse repos, through special bonds, prices are still falling. Producer prices are in decline. This means factories are charging less for their goods than they were a year ago. This sounds good for a consumer, but for an economy, it is cancer. When prices fall, companies make less profit. When they make less profit, they cut wages and fire workers. When workers have less money, they buy less stuff. And when they buy less stuff, prices fall even further. It is a doom loop. The central bank is pouring water into a bucket that has no bottom. The liquidity is entering the banks, but it isn't turning into economic activity. The analysts know this. They have crunched the numbers. They estimate the total liquidity gap, the amount of money missing from the system, is nearly 2 trillion yuan. The government injected 8 trillion. The whole is 2 trillion. Do the math. Even after this record-breaking injection, the system is still short by over 1 trillion yuan. This is why the markets are reacting strangely. You see short-term relief because the banks didn't collapse this week. But the bond market is pricing in a long winter. They know that this money is just filling a hole left by bad debt. The money isn't going to new factories. It isn't going to be high-tech innovation. It is going to pay off the interest on old loans that should have been written off years ago. The transmission mechanism is broken. You can give a bank all the cash in the world, but if they are terrified of lending to a property developer who is about to go bankrupt, that cash sits in the vault. It becomes dead money. And right now, China is drowning in it. The money isn't just dead, it is being incinerated. To understand why 1.8 trillion yuan isn't fixing the problem, you have to look at where the cash actually goes. It is flowing into a black hole. That black hole is the Chinese property sector and the local government debt spiral. For decades, the Chinese economy ran on a simple model. Local governments would seize land, sell it to developers at a massive profit, and use that money to build bridges, roads, and subway systems. The developers would borrow money from the banks to buy the land. They would pre-sell apartments that didn't exist yet to regular people. They would use that money to buy more land. It was a perfect circle. As long as land prices went up, everyone got rich. But the circle has broken. Land prices are falling. Developers can't sell apartments. They can't pay back the banks. And because they aren't buying land, the local governments have lost their main source of income. Everyone is broke. At the same time, this brings us to a new terrifying signal that most people missed in the noise of the Lunar New Year narrative. While everyone was watching the central bank inject cash into the banks, the government quietly started talking about a bailout for the insurance sector. We are seeing reports of a $29 billion recapitalization plan that is roughly 200 billion yuan. They're issuing special bonds to save the insurance companies. Why does this matter? Because insurance companies in China aren't just selling life insurance, they are major investors. They hold massive amounts of real estate debt. They bought the bonds from the developers. When the developers fail, the insurers bleed. So now the government isn't just propping up the banks. They're propping up the insurers, too. They're plugging leaks in the boat with one hand while bailing water with the other. This is the definition of systemic contagion. The rot has moved from the foot to the leg, and now it is moving toward the heart. The central bank calls these market stability measures. They say the yuan is strong, sitting at multi-month highs. They point to the charts and say, look, the line is flat. We are fine. But the line is flat because they are holding it there by force. The strength of the yuan right now is artificial. It is being propped up by these liquidity injections and by keeping a stranglehold on capital exiting the country. This leads us to the reserve requirement ratio, or RR. This is the nuclear button. The RR is the rule that tells banks how much cash they must keep in the vault and how much they are allowed to lend out. Analysts are screaming for the central bank to cut the RR. If they cut it, it releases a tsunami of cash, permanent cash, into the economy. It is the ultimate stimulus, but the central bank is hesitating. They are tinkering with the loan prime rate, the LPR, by tiny fractions. 5 basis points here, 10 basis points there. Why? Why are they using these complex short-term tools, the reverse repos, the MLF, instead of just hitting the RR button and flooding the zone? Because they are terrified of the flood. If they cut the reserve requirement too deeply, they lose control. Once that money's out, they can't easily pull it back. If that money floods the system and people still don't spend it, if it just causes a run on the currency, the game is over. They are saving the RR cut as a last resort. The fact that they haven't used it yet tells you they are trying to manage this crisis with surgical tools when the patient actually needs an organ transplant. They are confusing liquidity with solvency. This is the critical error. Liquidity is when you are rich, but you forgot your wallet. You just need a loan until you get home. Solvency is when you have no money at home either. The Chinese property developers, the local governments, and now the insurers, they don't have a wallet problem. They have an empty bank account problem. Giving them a short-term loan via a reverse repo doesn't fix the fact that they owe billions of dollars on assets that are now worthless. The 8 trillion yuan injection buys them time. It ensures the ATMs work during the holidays. It ensures the bond market doesn't freeze up tomorrow morning. But it adds such 8 trillion yuan of debt to a system that is already choking on it. They are solving a debt crisis with more debt. And this brings us to the ultimate danger. When you keep adding pressure to a sealed container, eventually the pressure finds a way out. If it can't come out through growth and it can't come out through inflation, it will come out through the currency. They are trapping the pressure inside the yuan, and that is a problem for the entire world. This brings us to the ghost that is haunting Beijing. They are staring directly at the history books, and the chapter they are reading is titled Japan. In the 1990s, Japan did exactly what China is doing right now. They had a massive real estate bubble. It popped. The banks were left holding trillions in bad debt. Instead of letting the banks fail and cleaning out the system, the Japanese government kept them on life support. They invented the term zombie banks. These were banks that were technically alive because the government kept injecting cash, but they were dead inside. They couldn't lend. They couldn't grow. They just existed to service the interest on their own debt. Japan spent 30 years in stagnation. They call it the lost decades. Prices didn't move. Wages didn't move. The economy just froze in time. China is terrified of becoming Japan too. 0. But there is one critical difference. When Japan's bubble burst, they were already a rich country. Their people were wealthy. They had a safety net. China is facing this crisis before they have become rich. They are getting old before they get wealthy. This makes the 8 trillion yuan injection look very different. It isn't a stimulus. It is a desperate attempt to stop the clock. They are trying to buy time to transition their entire economy away from building apartments and towards building microchips and electric vehicles. But you cannot pivot a $17 trillion economy overnight. So they are stuck in the loop. They have to keep feeding the zombies. If they stop the injections, the property developers default, the local governments default, and the banks collapse. If they keep the injections going, they create more debt, more deflation, and more dead money. The pressure has to go somewhere. And this is where it hits you. This is where the domestic Chinese crisis becomes a global problem. If China cannot generate growth at home, if the Chinese consumer is too broke to buy goods, then China has only one option left. They have to export their way out of the crisis. They have to flood the world with cheap goods. They have to sell their electric cars, their solar panels, and their steel to Europe and America at rock-bottom prices. To do that, they need their currency to be cheap. Right now, they are propping up the yuan to stop capital flight. They are keeping it strong, but the economic gravity is pulling it down. The deflationary pressure inside China wants the yuan to devalue. If the People's Bank of China finally gives up, if they decide that saving the export sector is more important than saving the exchange rate, they will let the yuan crash. This acts like a release valve. The pressure inside the container shoots out into the global economy. Suddenly, the world is flooded with incredibly cheap Chinese products. This sounds great for a shopper at Walmart, but it is a nightmare for foreign governments. It destroys manufacturing in the US, in Germany, and in Mexico. It exports deflation. This is the signal everyone is ignoring. The 8 trillion WAN injection is just the internal plumbing. The external consequence is a trade war. When China exports its deflation, the United States will retaliate. We are already seeing the tariffs. We are seeing the bans on technology transfer. The world is splitting into two economic blocks. China is trying to keep its machine running by injecting trillions of yuan, hoping that the rest of the world will keep buying its exports. But the rest of the world is closing the door. So the cash gets trapped. The velocity of money drops to zero. The central bank can print as much as it wants. They can do a 2 trillion injection next month. They can do 5 trillion. It doesn't matter if the pipes are clogged. You're watching a superpower fight a war against its own balance sheet. They have the tools to delay the collapse. They have the control to hide the bad numbers, but they cannot change the math. Eventually, the debt must be paid or it must be defaulted on. There is no third option. The scary part isn't that China collapses. The scary part is what they do to prevent the collapse. If they choose to weaponize their currency to save their factories, it triggers a chain reaction that hits every portfolio in the world. You think inflation in the US was bad? Wait until you see what happens when the second largest economy in the world tries to export its depression to your doorstep. This leads to a much bigger question. If China devalues the yuan to save itself, the US dollar creates a countermove that could break the global financial system entirely. The currency war isn't coming. It has already started. And the first battle is happening right now in the bond markets. You need to see exactly how this impacts your money in the next 6 months. Click here to watch the coming currency war. I'll see you there.